You pour the SARK over the ARK, and you bet that they all drown, and no one gets out alive.
It's a strange time for growth stocks. That CNBC clip is from just 6 days ago, and in true Jim Cramer fashion, ARKK was up around 15% after he, whatever that was. Financial entertainers make their money in entertainment, not finance. For example, Jim Cramer's show is a sales funnel for memberships to CNBC's Investing Club. Financial entertainment isn't bad. That Mad Money episode was pretty exciting to watch. But as an investor, you should always ask yourself this question. Am I watching entertainment right now, or am I using this information to make an investment decision? In this episode, I'm going to show you the difference between financial entertainment and information. Your time is valuable, so let's get right into it, starting with the entertainment side of things. Here's a quick supercut of CNBC's recent coverage of ARK Invest on their January 27th episode of Mad Money. Do me a favor and pay attention to it like it was financial information, like your portfolio depended on it.
You know what? I know that people hate me when I just say, stay the course, or stay put during a correction. Nobody wants to hear stay the course. They want action. Yeah, they want an excuse to sell everything and then circle back at a lower level, the right level. I can't blame them. However, if you own the more conceptual names, the formerly huge winners, betting that they'd be the next Tesla or the next Amazon or Apple, these are typically money-losing companies that stocks trade on basis of sales, not earnings, because there are no earnings. Now, some of them do make money, but they've gone out of style at the Wall Street Fashion Show because they're still revenue growth stories, and I don't know when they're going to come back. You know something? It's really a double whammy. The twin matadors of inflation and impending rate hikes. Either one could behead these stocks, but both is overkill. Now, this market's been down for a long time. I use the S&P proprietary oscillator to monitor the selling pressure. I go over it at 10:20 each morning in my morning meeting with Jeff Marks. You got to watch this. This is if you remember the club. You can't see it otherwise. And it's going to be stunning when I show it tomorrow and we talk about it. You should not be betting on these stocks. In fact, you actually might want to bet against them. How do you do it? Right, ladies and gentlemen, let me introduce you to the ultimate hedge. Let me introduce you to the ARK. More specifically, the ARK Innovation ETF, which is run by Cathie Wood, the best money manager of 2020, albeit not 2021 and probably not 2022. Now, Wood owns, this is the ARK, okay? Wood owns a ton of textbook growth names, Tesla, Teladoc, Zoom Video, Roku, Coinbase. It's kind of a curious amalgam of animals, pandemic plays, cryptocurrency enablers, medical health breakthrough companies, cost savers, and a streaming music service. Wood's favorites are often profitable. Their stocks have only recently begun to lose you money because their momentum plays that now have lost their momentum. I have a brutal solution for you. It's called the Tuttle Capital Short Innovation ETF. Its symbol is SARK, S-A-R-K, and it literally shorts whatever Cathie goes long. It's frankly too cruel even for me. But, man, I want to think of the SARK ETF as the scotch that happened to be my parents' choice. SARK, as in Cuddy Sark. Yep, you can buy some SARK and hedge your position. If you're worried this correction will continue, then stay the course in the stocks that are holding up, and then you use this thing to bet against the growth stocks that are the center of the blast radius, the ARK. So here's the bottom line. You pour the SARK over the ARK, and you bet that they all drown, and no one gets out alive. Let's take some calls.
The clear action to take here is to bet against growth stocks in general and Cathie Wood's stock picks specifically by buying Tuttle Capital's Short Innovation ETF, ticker symbol SARK. What are the biggest holdings that SARK is betting against?
Wood owns a ton of textbook growth names, Tesla, Teladoc, Zoom Video, Roku, Coinbase.
Got it. So here's an article that CNBC's Mad Money released on February 1st, just 3 market days later. Quote, Jim Cramer says he likes most of the ARK Innovation ETF's top holdings after the growth stock meltdown. CNBC's Jim Cramer said Tuesday that he likes the setup in most of the largest positions in Cathie Wood's ARK Innovation ETF, ARKK, Tesla, Teladoc, Zoom Video, Roku, and Coinbase, as well as why they're worthy considerations for your money. And honestly, all 5 of these are pretty good, super quick takes. Tesla doesn't have meaningful competition, Teladoc has a huge network and is down 70%, Zoom is permanently embedding itself in the enterprise, and it's surprising that Roku has fallen 60% because it's a lucrative business with a great balance sheet and a clear path to international expansion. Coinbase is the only decent option for a publicly traded proxy for crypto, and it's also down almost 50% from all-time highs. This looks like financial information, but it's the exact opposite of what Jim Cramer said just 3 market days earlier. And that's for a couple different reasons. First off, Jim Cramer is a trader, not an investor. That's not a bad thing, but it does mean that he thinks about returns on a much shorter time horizon. He thinks in terms of weeks and quarters, not years or decades. Second, Jim Cramer is an entertainer. Financial entertainers have no need to be consistent. They make money by ratings and views and selling courses and memberships and other products and services like access to their inner circle. They're not pitching you investments. They're pitching you themselves. Keep watching me. Keep buying from me. Learn to think like me. Here's Jim Cramer's pitch.
Now, this market's been down for a long time. I use the S&P proprietary oscillator to monitor the selling pressure. I go over it at 10:20 each morning in my morning meeting with Jeff Marks. You got to watch this. This is if you're a member of the club. You can't see it otherwise. And it's going to be stunning when I show it tomorrow and we talk about it.
That's it. Those 15 seconds is why that whole clip existed. It's got nothing in common with the article that Jimmy put out just 3 days later, except... oh, what's this? Sign up now for the CNBC Investing Club to follow Jim Cramer's every move in the market. If you're wondering whether the investing content you watch is information or entertainment, just look at which parts are consistent. If it's the pitch to join a club or buy a product, chances are it's entertainment. If it's the actual content, like somebody's ideas about the future, their framework, or their investment thesis in it, chances are it's information. And this past month, the information itself has been pretty exciting. So let's get into it, starting with Cathie Wood's combined positions. Sitting right at the top are the stocks that Jim Cramer wants you to buy and or short. Tesla, Teladoc, Coinbase, Zoom, and Roku. As I've been consistently saying for months now, Cathie Wood has been slowly selling Tesla and buying Teladoc. In their funds, ARK Invest currently holds over 14 million shares of Teladoc, valued at almost $2.2 billion today, even at its currently low valuation, making it their second biggest position overall, only after Tesla. In fact, if you look at the changes in their top 5 combined positions, their share count in Teladoc increased by a higher percentage than Tesla, Square, Roku, and Shopify put together over the last 90 days. But those 14 million shares actually tell me something else. The title of that episode is Cathie Wood has a new favorite, and ARK Invest buys it over Tesla stock. And I get it, it's not earning me any brownie points with the Tesla or the investing community, but it's what's really happening, so I feel I have an obligation to tell you about it. The first time I noticed this pattern was back in May of 2021. So I made that deep dive episode on Teladoc and have been covering ARK Invest's position in it pretty closely ever since. Now, 8 months later, my position on Teladoc has not changed. Good or bad, I think a lot of Cathie Wood's fame comes from ARK Invest's early call on Tesla, and many people feel she rode Tesla's performance all the way to the top through 2020. What the market is missing is that ARK Invest's best performing fund in 2020 was actually ARKG, ARK Invest's fund themed around the genomic revolution. ARKG beat ARKK and ARKW by double-digit percentage points. In fact, my 6th video ever was about the revolution going on in the gene editing space and why ARKG was ARK Invest's best performing fund, even though it doesn't hold Tesla, ARK Invest's best performing stock. I'm not trying to toot my own horn here. Okay, maybe a little. I'm trying to show you what long-term, data-driven, self-consistent, informational content looks like, compared to financial entertainment. My stance on Teladoc has not changed, even though it dropped over 70% since I started covering it. So if you're interested in what I think the market is missing on Teladoc, their acquisition of Livongo, and ARK Invest's research on the two, check out that deep dive. I'll leave it in the top right-hand corner of your screen right now, and in the description below as well. So here's my question to investors. Can we logically believe that ARK Invest got lucky with Tesla in 2020 when their best performing fund that year didn't hold it? If you believe that call on Tesla was thanks to research and not luck, that same research machine is now holding Teladoc stock at the same weight as Tesla. Let's take a look at ARK Invest's trading data over the last month to see what else the research has caused them to buy and sell more recently. This is a table of ARK Invest's combined holdings. Each row is one company, the rows are ordered by the size of Cathie Wood's position in that company, and each position is colored by its change in size since January, relative to the change in ARK Invest's assets under management. In January, ARK Invest's assets under management fell by $6.8 billion, or 22%, so each position is blue if it fell by more than 22%, and green if it shrank by less than 22%, or even if it grew. Here we are again. ARK Invest sold 9.6% of their Tesla shares, and Tesla's price fell over 20%, so ARK Invest is holding around 30% less money in Tesla than they were at the start of January. On the other hand, Cathie Wood bought a little more Teladoc, Coinbase, Zoom, and a lot more Roku as these stocks went down by double digits. It looks like Jim Cramer agrees and or disagrees with Cathie Wood's top choices, depending on which minute you ask him. If we sort this table by change in share count instead, we can see which stocks Cathie Wood bought the most of, as all growth stocks continue to slide. I'm going to focus on only the top 50 holdings by rank for now, since those should be the ones that ARK Invest has the highest conviction in. So, Cathie Wood heavily bought the dip on C Limited, Roblox, Ginkgo Bioworks, Robinhood, Intellia Therapeutics, Block, and Roku. She also bought the dip a little bit on Coinbase, DraftKings, Twilio, and Zoom. If we flip this table, we can see what stocks ARK Invest has been selling out of. We can see that they completely sold out of Netflix, Pinduoduo, and Tencent over the last month. Their share prices didn't actually go down by 100%, they're just not in ARK Invest's dataset anymore after they got sold, so all of my code fills this in with zeros. ARK Invest sold almost all of their shares in Takeda Pharmaceuticals, Snapchat, Skills, and DocuSign, resulting in these huge changes in rank. Almost every stock on this part of the list is down by double digits, and ARK Invest decided to sell a big chunk of each instead of buying the dip, resulting in these big drops in overall positions. However, none of these stocks were too high ranking to begin with, which makes sense because Cathie Wood drops her lowest conviction stocks for the highest conviction ones when everything goes on sale. Since I did a deep dive on Skills in the past, I went back to see what caused this massive change in conviction. The two things that I found at a glance were that Skills recently raised $300 million by selling senior secured notes at a 10.25% discount, which is like taking a loan at over an 11% rate. What do they need that money so bad for that they're willing to borrow it at such a high cost? What if they need to borrow even more money as interest rates rise, as they're literally about to? The other issue appears to be how Skills accounts for marketing spend and reductions in revenue under GAAP rules. GAAP stands for Generally Accepted Accounting Principles, and it's how every publicly traded company reports their finances. Basically, Skills calls incentives for new players reductions in revenue. Skills calls bonus cash offers and other incentives for existing players sales and marketing costs. I won't lie to you, I don't know every GAAP rule out there, but I do know that when you're a publicly traded company, messing around with accounting never looks good. In fairness, if you're interested in seeing Skills' side of this accounting issue, you can check out the end of their latest investor presentation, where they go over their accounting for end-user incentives with detailed examples. You should decide for yourself if that helps their cause or not. I'll keep digging, but honestly, borrowing money at an incredibly high rate and raising questions about accounting are probably enough to make Cathie Wood look elsewhere. The other sale I want to cover is Palantir, because I've been getting a lot of tweets and comments about it. A lot. First off, Palantir is still a top 20 position at ARK Invest. It actually went up one rank over January. Cathie Wood net sold a whopping 6% of her shares. The word net is important here. Here's how that sale broke down fund by fund. She sold over 90% of the Palantir shares in ARKG and ARKF and about 23% of the shares in ARKW. She actually added 8% more shares of Palantir in ARKQ, 14% more in ARKX, and 6.3% more Palantir shares to ARKK. You know, the highest conviction flagship innovation fund, the one that Jim Cramer likes and or wants to drown. Wow, that really never gets less weird. What can Palantir getting sold out of 3 funds and getting bought in the other 3 tell us about ARK Invest's conviction? In my opinion, this means that as every genomic and fintech stock goes down in price, there are better or at least more pure play options in these spaces than Palantir. Palantir getting sold out of ARKW is also pretty interesting to me, since I figured that's a fund that Palantir would fit pretty strongly into. That doesn't make Palantir a bad stock. It just means that it got traded out for companies that are considered more pure play in those spaces. The biggest increases in ARKW by share count were in C Limited, ticker symbol SE, and Cloudflare, ticker symbol NET, both of which are also pretty big positions in my own portfolio. And guess what? Palantir's stock price fell by less than C Limited's and Cloudflare's, which could have something to do with it. Seeing Palantir get more shares in ARKK, ARKQ, and ARKX tells me that Cathie Wood still has high conviction in the company in general, and that it's making meaningful impacts in the robotics and space areas specifically. That makes at least a little sense to me, since Cathie Wood often says that Palantir is going to keep pushing computing out to the edge.
Palantir has the opportunity to usurp a lot of AWS, Azure, Google Compute over time. It is pushing artificial intelligence out to the edge.
That edge means devices like cars and robots and drones and satellites and all the other cool technologies that Palantir's solutions and platforms can get deployed on, and don't necessarily touch the cloud. We'll see if that theory ends up shaking out, but that's my current guess. If you want to share your thoughts on Palantir, or any other growth stock or cryptocurrency for that matter, you're welcome to join my absolutely free 4,500 member Discord community. There are channels for everything from cloud computing and electric vehicles to genomics and space exploration. If you're interested in that, I'll leave an invite link for you in the description below. And of course, if you want access to all of the data dashboards that I just showcased throughout this episode so that you can come to your own conclusions without waiting for me to make a video about the stocks you care about, consider supporting the channel as a patron on Patreon or channel member right here on YouTube. I update these data dashboards myself every day by hand. See? There's my version of the Jim Cramer Cool Kids Club, or whatever he's selling these days. Hopefully, this episode gave you some food for thought on entertainment versus information, with what I think are good examples of each. There's nothing wrong with entertainment on CNBC or on YouTube, and not all information is useful information. But there is a real danger in mistaking one for the other, and I encourage you to really think about the consistency of the investors you choose to follow. So, stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.